Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of business reporting. And today we are diving into Stellantis' latest annual report. It's a massive document and it's got some really interesting stuff in it that tells a big story about where the company is and more importantly, where it might be going. So buckle up because this is not your average car company update. And if you appreciate getting straight insights from corporate documents, make sure you're subscribed and join our Discord community, linked in the description below. Alright, let's get straight into it. Stellantis is a global car maker designing, engineering, manufacturing and selling vehicles and components. Worldwide, they have a huge lineup of brands from luxury, like Maserati, to everyday European and American favorites. And get this, in 2025, they shipped 5,484,000 vehicles. That sounds like a lot. And it is, but here is the kicker. They reported a net loss of 22.3 billion euros. That is a huge swing from a profit of 5.5 billion euros in 2024. Now, they also talk about adjusted operating income, which they call AOI. Think of this as their way of smoothing out the super unusual one-off costs to show what they consider their core business performance in 2025. Their AOI was a loss of 842 million euros, a big drop from a positive 8.6 billion euros in 2024. This really shows the impact of those strategic changes they're going through. So why this huge loss and drop in AOI? Well, in 2025, they swallowed a lot of charges. They recognized 6.6 billion euros in platform impairments. This means they wrote down the value of some of their vehicle platforms because their future money-making expectations dropped, probably due to a mix of lower sales projections and higher costs. They took a big hit in North America, specifically 5.7 billion euros. On top of that, they incurred 9.1 billion euros in costs related to changing their product plans and cancelling programs like the planned Ram 1500 electric vehicle, which they decided not to move forward with because customer demand and regulations shifted. This is a massive number and shows a big strategic pivot. And then there are the charges related to battery joint ventures. They recognized 2.1 billion euros in costs here, mainly because they decided to exit a joint venture with LG Energy Solution called Nexstar Energy Inc., and also impaired their investment in the automotive sales company, or ACC. These are key parts of the electric vehicle strategy. So this shows a significant adjustment in their EV plans. They also decided to stop developing their hydrogen fuel cell technology program that alone cost them 1.1 billion euros. Because fuel infrastructure is limited and consumer incentives are not strong enough, this points to a more cautious approach on certain cutting-edge technologies given the current economic climate. All these one-time charges resulted in that massive 22.3 billion euro net loss in 2025 compared to a solid 5.5 billion euro profit. In 2024, it is clear this year was about a major reset for Stellantis. Looking at the segment breakdown for adjusted operating income, it is a mixed bag. North America went from a profit of 2.6 billion euros to a loss of 1.8 billion euros. That is a huge drop. Enlarged Europe also flipped from a healthy profit of 2.4 billion euros to a loss of 651 million euros. The Middle East and AF. Rica segment did show a profit, but it decreased significantly. South America maintained profitability, but also saw a decrease. China, India, and Asia Pacific showed a small profit after being in the red the previous year, and Maserati, the luxury brand, continued to post losses. Especially in North America, where they make a lot of their money. Things got tough. Shipments were up a bit, nearly 3%, but net revenues dropped almost 4%. This was largely due to currency issues with the US dollar and higher customer incentives. This means they had to offer more discounts to sell cars, which hurt their bottom line. The biggest clue here is that their plan for the US saw significant changes. They talked about a reset of the plan, and that is reflected in the numbers with a big drop in profitability. In enlarged Europe, the situation was similar. Shipments fell more than 3% and net revenues dropped over 2%. This was blamed on pricing pressures and lower volumes. It's clear the European market is tough with increased competition. The shift towards electric vehicles is also a challenge with new platforms and powertrains needing a lot of investment. Now let's talk about money available to keep the lights on. Stellantis had total available liquidity of almost 50 billion euros at the end of 2025. This sounds like a lot, but it is a decrease from over 51 billion euros in 2024. Their industrial free cash flow was actually negative 4.5 billion euros, meaning their core car manufacturing business burned through cash. That is a big red flag and a major concern. Where did that cash go? Well, they paid out 2 billion euros in dividends to shareholders, even with the losses coming in. This is a choice shareholders can make, but it does impact available cash for investment and operations. To fund their operations, they borrowed a lot of money. Their total debt increased by 8.7 billion euros in 2025, which is significant. This was driven by new bond issuances and increased financing for their financial services. They did repay some loans, but overall debt is up considerably. The report also highlights a ton of risks they are worried about continued drops in vehicle shipments, especially in the US and Europe. Global economic conditions, tariffs, and trade policies are big concerns, and the big one, the transition to electrification, is complex. They admit they overestimated the pace of EV adoption and had to take massive charges because of it. This is crucial because it means their electric vehicle strategy is being completely rethought. They also mention a focus on improving customer satisfaction and product quality, because remember those challenging quality issues with new platforms and powertrains in 2024 and 2025. This is a real threat to their reputation and market share fighting, for customer trust is paramount. And of course, cybersecurity is a major point of concern. They acknowledge the growing threats from hackers and the need for constant monitoring. The risk of disruption and data loss is very real. In today's connected world, they do have a program in place, but it is an ongoing battle. Now, onto the leadership front, there has been quite a shakeup. Antonio Filosa took over as CEO in July 2025, and a new leadership team was established. This is part of that broad reset and reassessment of their long-term strategy. The report mentions they are preparing to communicate a new strategic plan. This signals a major shift in direction, likely acknowledging that the previous plans weren't fully working out. Looking at compensation for the top brass, it's interesting. The former CEO Carlos Tavares received a hefty severance package, even though the company posted a huge loss. Antonio Filosa, the new CEO, has a base salary of $1.8 million. But his total compensation package includes performance-based bonuses and equity grants that are heavily dependent on company performance. Notably though, even with the massive loss in 2025, neither the CEO nor the chairman received an annual performance bonus. This is a positive sign of tying pay to results even in tough times. So what is the bottom line? Stellantis is navigating a massive and challenging transformation. They took huge charges in 2025 to realign their strategy, particularly around electrification and product plans. This resulted in a big net loss for the year, but it also shows a serious attempt to fix what wasn't working and prepare for the future. The numbers show a company in transition, facing significant headwinds, but also making decisive moves to address them. The auditors Deloitte and Associates did sign off on their internal controls, and those big financial statements saying they present fairly according to international financial reporting standards, but they did flag a few critical audit matters, big ticket items like product warranty provisions and the recoverability of non-current assets. These are areas that require a lot of management judgment, and our auditors spent extra time digging into them. Ultimately, Stellantis is making some tough but potentially necessary decisions. They are facing intense competition, regulatory pressures, and economic uncertainty. Their strategy is clearly shifting away from the aggressive electrification push of the past towards more flexible demand-led approach. This is a high-stakes game for them, and their ability to execute this new strategy while managing costs and quality will determine their future success. It is a car company trying to reinvent itself in a rapidly changing world, and the next few years will be critical to watch. So what do you think about these massive charges and Stellantis' strategy? Reset, drop your thoughts in the comments. If this breakdown was valuable, hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description for more discussions and insights. Thanks for watching, and see you next time.